Hey everyone, welcome back to my channel. Thank you so much for spending some minutes with me. Today I want to show you how I invest in real estate through a website called Fundrise. So what you see on the screen, this is my portfolio. I just started recently with this. I invested initially $300 and then my plan is every week to invest another $50. And so here we see the contribution, and also I've already received payment for some dividends. This is the value of those particular shares I have for this portfolio. It's a bit down, and then there are some advisory fees. And so there is also the composition of my particular portfolio that we will discuss later. But the reason I like to invest in real estate through Fundrise versus, I also have some in Vanguard and some other funds. But the reason I like this is, one of the reasons is this. Basically, if you go into, I think it's articles and podcasts, they write these letters to investors where they give you details about the state of the industry. And I like this a lot. I think for the first time, someone is explaining things very simple to me, and I like that. And also, I think they are cautious in their strategy, and at least based on what they say, and that's also I also like. So let's go through this quickly. I will show you also like some details about my portfolio later, but I wanted to spend some time here. The reason I like these letters is, for example, they tell you that, or they show you that in the latest recession that happened in the mid 2000s, at some point the Federal Reserve was increasing the interest rates. And so since the moment that they increased the rate for the last time, it took about 17 months to go into recession, and then another X months to bottom in the stock market. And then if we translate that into the market, there was a 53% loss in that market. So this means that over the next few months or quarters, at some point we will peak in the interest rate. The Federal Reserve is still mentioning that they want to increase it. And so that's going to trigger the starting point for when we reach the recession in some months, and then the bottom of the stock market. So if we go farther down, they give some other examples, but I like this table. This table talks about the same since 1969. So here you can see, for example, that since the peak of the interest rate to the recession, it took 8 months, 5 months, 7 months, 16 months. So on average, over the past few recessions, it's 10 months. And then from that peak interest rate to the stock market bottom, it's an average of 21 months with an average of a 43% decrease in the stock market. And then if we now translate that into today's dates, right? So it's we are in August at the moment. If based on the latest feedback from the Federal Reserve, if they keep increasing the interest rates, they will probably peak, at least that's the assumption now, at some point in December. And then this means that based using these 10 months, the recession would start at some point in November 2024. And also based on this, in August 2025, that's when the stock market would bottom at an average of 43% below the peak or the market at when the peak of the interest rate happens. So this is, I like this transparency, meaning it's difficult for me to find this clarity when I read some other articles or some other blogs. If I scroll at the bottom, they mention how they have started protecting the investors and looking ahead, and they know that the recession is coming and the stock market is going to bottom and there's going to be some possible crash. So they have started to make some movements that will basically protect us and our investments as much as possible during that recession. I've not seen, at least at my level, other types of articles like this one in other investment funds I'm doing. And I just like the clarity here and the transparency. And if you go into articles, you will find many more on a quarterly basis, also related to particular topics and how things are going and how they are investing or protecting the funds so that, the investors are as much protected as possible as well. So I like that versus, increasing the risks too much. So if we go into this other page, when I started investing those $300 and the $50 that I would do on a weekly basis, I was presented with this chart. You can select your strategy here. In my case, I'm doing the first one. I'm interested in supplemental income, meaning, let's suppose I had $10,000 invested and there was a 10% return. That means that every year I would get $1,000 in dividends. And on a monthly basis, that would probably be around, let's say, $100. So as you can see, the strategy here is to maximize the dividends. And I'm interested in that supplemental income on a monthly basis. If there is a recession coming and the market needs to crash, etc., as you can see also like from the charts a little bit, like this is just for explaining purposes, but where you maximize your return initially is if you do the dividends. And then if there is a crash, this will be the starting point again after the crash, and the same here. So yeah, you can play the long vision, the long term in these other strategies. But in this particular one, I just want to maximize the income, and you can do your own strategy here. And so then if we go into the portfolio itself, this supplemental income, in my case, this meant that those $300-400 that you saw in my portfolio, most of them were invested in what they call their income real estate fund, and there is also a smaller percentage in their flagship real estate fund. And so when we go inside this fund, I also like the fact that I see this much detail into my account. So I see, for example, the particular assets that are in this fund. I've not seen this anywhere else so far in other funds or so that I've invested through other systems. In this particular case, this fund has 52 assets, and by assets, this means like massive development properties. For example, this one here or this one here. Like if I maximize this, I'll do it later, but you can see these are all like houses with their streets and everything. So they have invested $27 million in this, or $15 million in this one, $50 million in this other one, etc. So I like to read about the assets they've bought. I like to read, the composition and why they invested and stuff like that. So if we do the breakdown, remember this is 52 assets in total. Let's check the real estate debt. This is 12 assets. Let's check preferred equity. That's 14 assets. So the majority, I've done this before, is the home builder finance, and that's 22 assets. Just to give some additional feedback, when companies like them do investments in real estate, this is like any other real estate transaction. So usually if you buy a house, there is a 20% down that you need to put. That would be like your equity. And then the bank puts the other 80%. And so in this case, they also have some other tranches in the middle where they have, it's a little bit equity, it's a little bit debt. So it's called preferred equity. And what ends happening is, if there is an issue and the market crashes or people cannot pay and all this stuff, and there is some defaults, etc., the one that is at the bottom, like in this case the debt from the bank, that's the one that gets paid first in case of liquidation, right? And the second one is the preferred equities, and then at the end of the day, whoever the money left on the table is spread amongst the shareholders. And you can go through this article in much more detail and better explained than to what I did right now. I'm just saying this because now, for example, if we come here, we say, okay, let's check the assets that are preferred equity. And let's open this one about the pool. You can see the breakdown, right? So in this case, Cross First Bank lended some money, about $22 million, so that would be probably repaid first. and then this particular asset sits in the middle. So they would get repaid before the developer gets paid their $9 million. So let's go back. The other thing I like to do is to check, as I said, the updates or the characteristics in some of these investments or some of these assets. So if we open, let's take this one in Mount Juliet in Tennessee. This is a $27 million investment. You can see here the layout of where this will be built. And then I just jump quickly into the update here, where it talks about why they invested in this particular asset. And it says here, this asset, just as an example, it's 80 acres, roughly 35 minutes from Nashville. And this has 190 single family homes. And in order for, when they provided this investment, they are getting paid 10.5% annually because of this loan. In terms of strategy, it's low to moderate, so it's not very risky in principle to have this type of investments. And then they provide some other information that justifies why they decided to invest. So again, in my case, as I said, this is just the start of my portfolio. I plan to invest here over the next few weeks and months and quarters, and I'll be making additional videos in the future regarding the dividends and the real return I get from a portfolio like this one. So thank you so much. Please remember to like and subscribe, and talk to you soon.